Practical accounting, the better way to learn.
Okay, welcome back. This is module 2.3, how the process works. We're getting less theoretical and more apply and practical as we go along. So let's go back to our original framework. Financial accounting is a foreign language, the language of business. So no matter what field of business you're going into, you need to understand what these terms mean and how they are applied. The rules, the big rules, are principles, which we're going to take a look at more carefully now. The methods are going to be covered in each chapter. Transactions are business events that add or subtract from the balance of accounts, which are rearranged into a form called financial statement. But let's take a look at the four big rules, two of which we've already talked about. Revenue recognition is the first one. And again, in blue, all terminology in practical accounting is in blue. Revenue recognition says that both, before you can say, I made the sale, the revenue has to be either realized, which means collected as cash, or realizable, which means a bill was given or could be given to the customer. But that's really not usually the issue. The issue is, have we earned it? Have we earned it by, again, a performance obligation being satisfied, which means delivered to the customer, and we'll get to that. This prevents companies from overstating or exaggerating net income by reporting revenue before it's actually made. The second one, expense recognition or matching principle. All expenses used by the business to create the revenue should be added in the same time period as the sale. This prevents companies from overstating net income and ignoring the cost of making the sale. So both of these principles are important to make sure that you're not reporting too much net income. The third one is the historical cost principle. Now, those of you, this one is an important one in US GAAP, less important in international financial reporting standards, but we'll get to that as we go along. An asset, the historical cost principle is an asset's value is at most what you had originally paid for it, even if it's worth more now. Now, a lot of students have real problems with this, but here's the deal. If you have, let's say, a building that you bought for $100,000 100 years ago, and it's now worth $1 million, it's still booked at $100,000. And that is not right, but it, on the other hand, it prevents overstating net income or overstating assets by reporting gains in value that are still owned. You can report that gain when you dispose, which means sell that asset. The fair value principle is the opposite. It provides exceptions to historical cost. However, it is only rarely used in US GAAP, again, more frequently in international standards. The final one is the full disclosure principle, which says tell everything that's material, which really is important. Tell everything that's important, even if it's from bad news. So this prevents hiding bad news to users in the financial statements or in the notes, which provide a lot of extra detail about these. So these are the big rules, and we're going to be hitting them as we go along in this whole chapter. Now, this next one, yeah, there's a lot of information on this page, but it's all right here. Accounting qualities. Okay, these are enhancing qualities. and I'm going to go through them quickly, but you can refer back to this. Relevance. The two main things are relevance, which means useful to predict the future. Faithful representation, which means accurate, complete. And neutral, which means no spin, and free of error. So this is what we are after, is truthful, and this is how you add trust. They also should be comparable to similar companies. Verifiable, which means dependable and accurate, and that it's been checked and independently checked by the auditors. Consistently use the same methods over time. Don't be changing it. Timeliness. Issue them soon. Okay. A lot of goals here. We're constrained by materiality and cost. Materiality means relevance is smaller in small businesses than large businesses. So $100 error in Hot Dogs or Us would make a difference. It wouldn't make a difference in a company like the size of Amazon. So, you know, how big is big? The other one is cost. You're going to pursue accuracy, but you don't do it to the sense where it puts the company out of business. You don't spend $100 to fix a $1 potential error. Common assumptions, which are defining rules, are the time period assumption, periodicity sometimes called, which means consistently report every month, quarter, and year. Okay, typically for external reporting, it's quarters and years, which is 3 months. Okay, consistently. Separate entity assumption. This was Hot Dogs or Us, that first real transaction where you took money out of your personal pocket and invested it in the business. The businesses and companies are separate from their owners. Don't mix personal business assets and expenses. Monetary unit. Monetary unit means you measure it in money, okay, which in the US is dollars, and it can be whatever currency, but you don't say, I own a truck. You report the value of a truck as a long-term asset. And going concern, which means unless you're actually going out of business, you can use historical cost. You don't have to value your inventory and other assets as though you're about to go bankrupt and have a going out of business sale. So lots of definitions here. You can refer back to them at any time if you have questions. John, do you have anything to add?
And I think you just define everything in one sentence form, which is excellent.
You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.